The next thing we're going to look at is free cash flow. Now, free cash flow is not really a metric necessarily. It's not something that we can compare against companies or across the industry. It's sort of like an individual company scorecard, but it's something that's essential for later down the road. And I'm going to explain that in just a second. But free cash flow is the cash a company generates after spending the money required to maintain its assets. So this is not EBITDA. This is free cash flows. What money you have left over after you've maintained all of your assets. So what the calculation is we take the net cash provided by or used in operating activities and we subtract out capital expenditures. So we're not looking at the total cash flow statement. Remember, there's cash from operating activities, financing activities, and investing activities. Well, we don't care about the investing activities or the financing activities because those have to deal with raising money and things and paying down debt and things like that. What we care about is the cash from operating activities. And then we subtract out capital expenditures because that's what it takes to maintain our asset base is the CapEx, the capital expenditures. So that is the calculation for free cash flow. Now, here's an example. Let's say a company generated $100,000 in operating cash flow and had $25,000 in capital expenditures. Well, the free cash flow would be $75,000. So we take the $100,000 in operating cash flow and subtract out the $25,000 in capital expenditures. Now, like I said before, the free cash flow is difficult to compare across companies since it's not a ratio or it's not some type of metric. But it is essential when looking at an individual company, and especially when we are trying to value a company. Now, we will go through company valuation in the financial modeling course. We don't go through that here, but it is an essential metric you need to know. Because if the company is not producing cash, then you can't survive as a company. You need to know how much cash you are actually producing, and not just cash, but free cash flow. So we don't want to include all of the cash that we receive from the debt proceeds and everything else. We want to know about free cash flow. Now let's go ahead and go to the financial statements and let me show you how we are going to calculate free cash flow. So we are on the Excel spreadsheet and we are on food and stuff statement of cash flow. And I'm going to come down here to the bottom where we have space for free cash flow. Now remember, free cash flow is we are taking the cash from operating activities and then subtracting out CapEx, capital expenditures. That's the money that it takes to maintain our asset base, make sure that we're still good to go. So what I'm going to do is do equals. I'm going to come up here to the operating cash flow. And then I'm going to add in the purchase of property, plant, and equipment. That is our CapEx. I'll hit enter, and we see that cash was negative $2.1 million, so free cash flow. Copy that over. So we see that in 2015, we had positive cash flow, positive $3.7 million in free cash flow. That is phenomenal. We don't want that number to be negative. Because if that number is negative, guess what we need to do? That means that we need to go take out debt or raise equity in order to cover that shortfall. So if you look over here in 2016, I should scroll up so you can see that's 2016. There we go, 2016. We see that free cash flow was negative $2.7 million. So that means cash was going out faster than we were receiving it. That means that in order to fill in that cash loss, we need to raise some type of money, whether through debt or equity, or sell property, plant, and equipment, or do some other type of thing to make sure that we don't have negative cash flow. Well, the situation got a little bit better in 2017, and our free cash flow was only negative 2.1 million instead of negative 2.7 million. So it got better, but still not great. We want free cash flow to be positive. At any company, cash flow is king. It doesn't matter how profitable your company is, If you have negative cash flow, you will go bankrupt. That's just the name of the game. If you don't have money to support your operations, you will go bankrupt. And so that is a big thing that a lot of people fail to recognize. They just say, oh, look, we have a lot of cash in the bank. We have 9.5 million and 7 million, 3 million. Well, yeah, you have 9 million bucks in the bank, but that's because you had to go raise equity and take out debt in order to get that cash. But in reality, your free cash flow was negative. So that's not a good thing. So when looking at the financial statements, we can't just look at the gross numbers. We need to do some calculations, back some things out, and really get down to the root metrics that are going to let us know how the company is doing. In this case, we have negative free cash flow. That is not good at all.
And that's it for our video on free cash flow. Be sure to like and subscribe.